So welcome to KSB's webinar. This is the 17th webinar. We are delighted to have Dr. Hassan Malik with us. He's an investment analyst at Prince Street Capital Management in New York, which is an emerging markets focused fund. Hassan is a PhD in economic history from Harvard University. He has been an investor at and has been associated with financial markets at places such as JP Morgan and now with Prince Street Capital. It's a pleasure to have him here because not only is he a financier, but he's an intellectual and highly trained one in economic history. And he's an author of a book, Bankers and Bolshevik, International Finance and the Russian Revolution, about which he will talk today. So over to you, Hassan. Just before that, the format of this webinar, like our previous webinars, would be a discussion for 40 minutes in which Hassan will run through his book, and then we will open up for Q&A. The recording of this video will be available on our website, which is ksb.com. It will also go on our Varsity, the online MOOC, which is ksb@teachable.com. More than 1,500 students are enrolled in that course, which makes it the largest business course in Pakistan. So, with that, over to you, Hassan. Delighted to have you join us today. Thank you for your time.
Thank you, Ali. It's very kind of you to have invited me. I'm going to be talking today about the largest default in history. And many people, when they think about this, think about Greece, they think about Argentina in 2001 or 2012. But in fact, even if you inflation adjust, we're still looking at the largest default in history being the default after the communist revolution in Russia, the default that specifically took place a few months after the Bolshevik takeover in 1917 and in January 1918. In today's terms, this is a default that I don't think it's unreasonable to claim to be north of $1 trillion, inflation adjusted. And what struck me when I was both living in Moscow and going through the history books was just how much this default speaks to a kind of forgotten era of financial history, an unprecedented emerging markets boom that took place in the late 19th and early 20th centuries. In the Russian Empire, which really was the emerging markets of its day, not unlike, say, China today. And these remnants of this forgotten financial past are literally littered around the streets of St. Petersburg and Moscow. And so what you see on the screen are just two buildings in central St. Petersburg and Moscow, respectively, that stand to this day and are in the center of the town. And really, they were erected to house banks. And what really struck me in reading this history was this was not just forgotten banks of the age, but banks that are still very much here with us today. So Citibank famously opened its first branches in the Russian Empire in 1917, the last months before the revolution. It did so at around the same time as Midland Bank, which was then one of the largest British banks, ultimately swallowed up by HSBC, also opened its branch. And what really struck me in doing the research for this book was that this was not just a story of pre-revolutionary investment, but expansion even after the moment of the communist takeover, such that Citibank actually opened its second branch in Russia a few weeks after the communist takeover. Now, as puzzling as that might sound, what was to me truly puzzling is that the investment community, the financial markets, had been warned about a potential disastrous revolutionary outcome. And they've been warned about this during the crisis of 1905, 1906. Now, I recognize that most people are not really in the weeds on Russian financial history. So in a sense, here's a slide just walking you through some of the key events leading up to the communist revolution, because of course this was not an overnight affair. And so basically the story begins in the 1890s. It goes through the Russo-Japanese War of 1904, 1905, which saw Russia humiliated as a European power by what was then up to that point perceived to be an upstart Japanese empire, which actually thrashed the Russians. It continues through the First World War, which of course broke out in the summer of 1914. And a big participant in that war was the British Indian Empire. And then it goes through the two revolutions of 1917. So most people don't realize that actually there was a first revolution in February 1917 when the Tsar, the Russian emperor, was overthrown and replaced by a nascent constitutional democratic regime, or at least an attempt to move Russia towards a constitutional democracy. And that was a very short-lived affair, which ended in October in the old style, November in the new style calendar, 1917, when the communists essentially engaged in a military coup and put an end to the Russian democratic experiment. Now, this moment of 1905 was particularly important because it's the first time that the man on the screen, Leon Trotsky, emerges on the world revolutionary stage. And he does so not just as an opponent of the regime, and not just at a time when Lenin and the more famous Bolshevik leadership is relatively underrepresented or relatively quiet. He does so with an explicitly financial attack on the government, which was really unprecedented in Russian history. And he does so through this body called the St. Petersburg Soviet, which was essentially a government in waiting, if you will, waiting to push the Tsarist regime out and install its own. And this St. Petersburg Soviet was shut down just days after, hours after publishing a so-called financial manifesto. And I think on the screen, it's worth reviewing what this manifesto called for. Specifically, it called for refusing all payments to the Treasury, demanding of payments of wages in gold. Remember, this is a time when Russia is on the gold standard. It had joined the gold standard in 1897. So in our terms today, this would be the equivalent of, say, revolutionaries in Pakistan saying, stop paying taxes to the government and expecting to be paid in dollars rather than rupees for wages. And then there was also an orchestrated run on the central bank's reserves by demanding payment in gold. So again, this would be the equivalent of trying to withdraw dollars and hard currency from an emerging market banking system today. It puts obviously a very big strain on the money markets. Something that we witness when we look at what the central bank was doing, it essentially increased the interest rate by 2.5% in 2 months. Now, obviously, we've seen what the state bank is doing in the current crisis. In a crisis environment, you oftentimes want to loosen monetary policy. But the Russian government, in a similar economic crisis, was forced to raise the interest rate just to prevent gold from leaving the country. Now, you might ask, what is it that drove this boom, and what is it that drove so much capital into Russia that it prompted a gold standard, and that it actually created a situation where the central bank was trying to defend gold reserves? How did it accumulate these reserves to begin with? Well, the man behind this story is the Russian finance minister and ultimately prime minister on the right, Sergei Witte, who is a fascinating character. Not unlike some of the finance ministers that we have in emerging markets today. And he really embarked on an ambitious program of debt-financed infrastructure development, which saw Russia quickly rise to the foremost ranks of railroad countries in the world. And it also saw an explosion in the Russian debt burden, or amount of debt outstanding, which, as you see on the chart on the left, basically increases by 50% in just over a decade. And again, this was all gold-backed loans, so this was external debt. Now, at the same time, if you look at the ratio of this debt to net national product, in our terms today, a rough proxy for debt to GDP, you see the burden, even as the nominal value of the debt is increasing, the relative burden relative to national output is decreasing. And that speaks to really some very productive investment. You saw a huge economic boom in Russia. It became the largest oil producer in the world, at one point accounting for 50% of global oil production. It saw a consumer boom, a textiles boom, a really broad-based boom that drew in some of the leading financiers of the age. Remember, this is the time before World War I, when Wall Street is still playing second fiddle to the city of London and Paris. And indeed, the French in particular, partly because of diplomatic reasons we can go to in discussion, and partly because of an abnormally high savings rate in a European context, we're driving a lot of investment into Russia. There was some direct investment from Germany, which had to do with a lot of familial ties. But increasingly, you saw Anglo-American capital come to play a larger and larger role. And this is indeed what comes to save the government at the point when the communists, led by Trotsky, are trying to push the government off the gold standard. The head of Barings Bank, the second Lord Revelstoke, one of the most powerful financiers of the age, orchestrates what was at the time the largest ever loan in history, a 2.25 franc gold-backed loan to inject capital into the Russian government's coffers at exactly the point when it needed it. And so this loan becomes a turning point in Russian history, and at the time was spoken of as the sort of the loan that saved Russia. And indeed, we see a sharp rebound in the Russian economy. We see industrial production basically go up 50% from the lows in just a matter of a few years. But I maintain that this actually was a questionable benefit. And what we see is, and I've got a quote on the screen from one of the sharpest observers of the Russian scene, a leading British diplomat who would ultimately become ambassador in Washington, saying, should a loan be issued without the previous consent of the representatives of the people, it will be repudiated. And so this brings in the question of debt policy and what is notionally technocratic financial policy, and how it interplays with political legitimacy when financiers come in and step up and prop up a unpopular and arguably illegitimate government. And this starts to create its own dynamic that plays out over the ensuing years. But in the immediate sense, what happened was we saw a boom, as I alluded to. We saw the risk premia on Russian assets collapse. So in layman's terms, in bond markets, what we often do is we think about what is the yields on one country's debt and what is the yields on the global safe asset, in our terms today, the US Treasury security. And what is that spread? If an emerging market borrower has to pay a very high premium to what the US government has to pay, that's an indication that financial markets are getting nervous. And conversely, if we see that spread collapse, that's an indication that financial markets are getting more comfortable with holding that debt. And so what you see on this chart is the spread of Russian government securities over the sort of the benchmark at the time, the British consul, collapsed, and they actually reach multi-year lows at points just months before the communist revolution, which itself was a very curious phenomenon to me. So what happens? What happens to transform this ostensibly strong rebound into a collapse, a revolutionary collapse, as well as a financial collapse? Well, in the first instance, it's the war, and it's also economic ideas that coalesce to work against Russian credit. So Russia, although a fast-growing state, was in some ways not dissimilar to Pakistan today, insofar as direct taxation, income taxation, was a challenge for the government. And at the time, the thinking was really not globally in favor of income taxes. And so what the Russian government did, they did what a lot of emerging market governments do, is it took a very regressive approach to taxation by charging essentially a sales tax or an excise tax on commonly consumed items. Now, as you may be aware, alcohol is very popular in Russia. Russians drink a lot of vodka in particular. And the government realized that they could actually squeeze a lot of money out of the population by enforcing a state monopoly on the production of alcohol and then taxing it heavily. And that's what they did to finance, to pay the costs of all the debts that they were raising in international bond markets. Now, when the war breaks out, it breaks out at a time when globally there is a move against the consumption of alcohol, and this is something that has globally taken a lot of pickup in academic and policymaking circles. So Irving Fisher, one of the most famous economists of the age, was a strong proponent of the temperance policies that were being experimented with in the US. And Russia joins the bandwagon. And the thinking is that sober workers are more productive workers, and that drunkenness militates against the effectiveness of the army. And so the Russian government basically imposes a vodka ban just as the war is breaking out. Now, this may have had positive health consequences. We don't really know. But what we do know is that for a country in which north of a quarter of government revenues came from the alcohol monopoly and alcohol industry, this had catastrophic fiscal consequences, such that basically almost overnight, a quarter of the government's budget revenues evaporate. And this is happening at exactly the same time as the Russian government needs to spend more and more money. So it's getting in less and less money from alcohol sales at the same time as it's spending more and more money on the war effort. And what you see here on this chart is just a breakdown of the way the government financed its war effort, which was largely through borrowing. So the Russian government had run a fairly conservative budget up to the point of the war, but that only, the surpluses they'd accumulate cover basically the cost of mobilization, so less than 10% of overall expenditures. 2/3, roughly, were covered by borrowing, which became more and more difficult. They were paying higher and higher prices to the lenders in the bond markets. That's the chart on the left. And the balance is made up almost 1/3 by essentially printing money. And so we see in this chart, the amount of money that the central bank had in circulation essentially increases by a factor of 10 over the course of Russia's involvement in the war, with predictable consequences. We see inflation, which in the pre-war era was relatively low because of the gold standard. Inflation just skyrockets. And we see a huge amount of urban economic dislocations. As inflation skyrockets, people find it harder and harder to come by goods, to such a degree that one scholar estimated that in the last year before the revolution, the average housewife in St. Petersburg was spending 40 hours a week queuing for basic necessities. Now, what was fascinating to me when I was studying this period in the archives in St. Petersburg was reading what some of the bankers on the ground were saying at exactly this moment in 1917, when the wheels are, in a sense, coming off the economy. And so what I have here on the screen is a quote from H.F. Meserve, who was Citibank's man on the ground in St. Petersburg. He'd been sent by the bank to study the situation, meet with the finance minister, industrialists, do a lot of the work that a typical emerging market analyst or banker would be doing today. And he ultimately concluded that January 1917 was the time for the bank to move into Russia. And so shortly after that, he writes to New York, and I think it's worth just quoting this: "Before this letter reaches you, you will have been thoroughly informed regarding recent events here. Naturally, at the time, it was nerve-wracking, especially for the ladies. But as I look back on it all now, I can only say, all things considered, that there was more self-restraint showed here by the Russians than would have, under similar circumstances, have been exhibited by any other nationality in the world. I'm very proud of the Russians for their wonderful self-restraint, and although matters here are still, of course, nervous for the individual, I feel more certain than ever that Russia itself will come out in the end stronger than ever. I still consider all foreign investments here advisable and safe, and I sincerely hope the US will now be willing to help Russia in every way." So this is a remarkable vote of confidence by a man who has very good connections in Russia, just months before the communist takeover. Now, what was to me very interesting is that you see in this chart, these are two separate bond price series. You see in the chart towards the right, the market does start to get a bit jittery and start to price in a bit of tension. And certainly after the Bolsheviks take over, there is this sort of spike up in yields. That's the orange line on the right. But what is really remarkable to me is that even in 1917, even after the communist revolution, the market was not really pricing in severe default. This is that same chart put into the context of the Greek and Argentine defaults. That's the purple and the brown line on the left that had happened in the 1890s. So even markets that had in the recent past experienced catastrophic sovereign defaults, ironically from Greece and Argentina, which again defaulted more recently in our lifetimes, even that market didn't really pick up on the extremity of the Russian situation, which would end up being much, much worse. This is that same chart rolled forward by a few years, and you can see that the stress experienced in Russian markets dwarfed ultimately that experienced in Greece and Argentina. Now, what was even more curious to me, and I have a quote up here on the screen from a prominent commentator in The Economist, the same magazine we have today, was that actually, even after the Bolsheviks in early January 1918 had declared and said, we are not paying and not acknowledging the debt, commentators continued to believe that they were bluffing and that they would get paid. And this really speaks to one of the many arguments that were bandied about, including by the man on the right, who was the head of Citibank at the time globally. And there were various arguments, but basically they took the frame of these: the Bolsheviks won't last, they can't be serious. Other governments will step in, notably the British and the French, who would encourage their citizens to subscribe to Russian loans. Russia remains a rich country, which is kind of the adage that every long-term investment is a speculation gone bad. And the Bolsheviks are not that bad in the end. They're businessmen, and we can deal with them in a business-like fashion. Now, for me, explaining the default is partly understanding what the investors were thinking, but also partly considering what it was that drove the Bolsheviks to default. That is, were it not for the Bolsheviks, would another Russian government have continued to pay the debt? And I basically come to the conclusion that this was a bad situation, however you cut it. The Bolsheviks in particular are often talked about as just being ideologically opposed to bankers, and so of course they would default. But I argue in the book that actually beyond the ideology, which we know well, there was an element of pragmatism. And this was also a particular weapon. That is, the default was a particular weapon that the Bolsheviks sought to deploy in a financial war that they were waging as much as their political and physical war. So we know, of course, that Lenin, in his various writings up to and during the revolution, railed against the bankers, railed against debt, and so I won't go into much detail there. But he also did have a very acute appreciation for the workings of the international financial architecture and the weaknesses therein that the governments had exposed. But also there was an issue of serviceability, and I think this is where the practical element comes into play. The reality is that, as you see on the chart, and these are indices of various components of Russian GDP at the time, the proximate impact of the war in 1914 was to unleash a bit of an economic boom, stock market boom, as well as a real economic boom insofar as wartime employment picked up, factories had all sorts of military orders they had to meet. And so in fact, I actually argue in the book that in 1913, the Russian economy was in a kind of weak situation. And thanks to the war, in a sense, it was saved from a recession because of the fiscal stimulus of the war. But nevertheless, by 1917, as you can see, entire sectors of the economy have collapsed to less than half of pre-wartime levels. And as I alluded to before, we also see a higher and higher yield being demanded by investors, even in domestic markets where the government was forcing banks, in a sense, to hold the debt. But I thought what was also particularly interesting about the Bolshevik move was that they did not just default on the debt, they actually repudiated the debt. They in a sense, marked it as odious debt, which is a term used to describe debt that countries deem illegitimate because prior regimes had contracted it without the consent of the governed. And this is really an argument that comes to the fore in the Russian case, but has some echoes in previous revolutions, not least the American Revolution of 1776. So in essence, when I think about the defaults, the argument that I make is that yes, ideology did play a role in the Bolshevik situation, but this was also a eminently practical decision, one that an alternate government would almost certainly have had to have taken, i.e. default. I think the particular difference in the Bolshevik situation, which the ideology description doesn't fully appreciate, is that the Bolsheviks also really revolutionized the revolutionary approach by seizing on the weaknesses in the financial markets that governments were experiencing and using that as a screw to turn above and beyond the traditional anti-government actions of demonstrations and terrorism and ultimately a coup d'etat. Now, as much as this is a story that ended 100 years ago, in some senses, we've never really broken from it. So the slides on the top highlight that actually in recent years, Russia and Ukraine had tussled again on this question of odious debt, whereby the last pro-Russian government in Ukraine was in a sense bailed out at the last moment by a loan from the Russian government, which was contracted and which subsequent governments didn't want to acknowledge. They said, you know, the guy that came before us was not legitimate and we shouldn't be held hostage by his political and financial decisions. And most recently, in literally the last few months, we have seen, as you see in the picture in the bottom of the slide, Lebanon erupt into nationwide protests. And a big component of the hatred that a lot of the Lebanese people have for both their political leadership as well as their technocrats is this series of decisions that has seen Lebanon's debt to GDP ratio skyrocket to such a degree that people just don't think the debt that Lebanon contracted from foreign investors is legitimate. So this is all to sort of underscore the point that even though what happened in Russia 100 years ago is in the distant past, the echoes of that history are with us in the present and arguably could even become louder as we move through the current coronavirus situation. So with that, I think maybe we can shift to some discussion, but thank you for your attention.
Thank you for that, Hassan. This was extremely insightful. Can you, if you stop the screen share option?
Yeah.
Great. Yes. So, you know, while you were talking, of course, there were a lot of parallels to be drawn with the debate and the situation in Pakistan. And I'm sure Pakistan is not the only country, as you gave the example of Lebanon. And so a lot of emerging markets might see the parallels between what happened in Russia. Last week, we hosted a webinar on sovereign debt by Ali Abbas Shah from IMF. And so, you know, it's a good continuation of that theme. And what I found very interesting was, you know, the historical context which you gave, that a lot of this money, what the debt was being taken to finance infrastructure projects, which is very similar to what we have seen in Pakistan. So from a fundamental level, my first question to you is that, do you think that debt inherently is bad? Because no matter how we start, the path which it leads to seems to be very similar across time and across countries.
Excellent question. And no, I don't think it is. I think debt intelligently used and sort of contracted with open eyes and with due diligence and with a plan can actually be incredibly useful. It helps transfer savings from those who have an excess of savings to those who have a shortage of capital. So that happened in Russia's case, from France to to Russia. In our terms today, it happens from all sorts of developed economies to emerging markets. But the question, I think, becomes, or the danger arises when people start taking on debt and use it for unproductive purposes or ill thought out purposes, or take on too much. That's where I think the problems arise.
Thank you. And in the case of, we had a webinar in which we asked Dr. Mark Mobius, and he said that he thought that the threat of a default by a sovereign country on debt is overblown, because he says that markets have shown that they have very short memory, and there are serial defaulters such as the Latin American countries. What's your take on that? Because that's a big question in Pakistan. We have never defaulted on our debt, but there has always been this concern that what happens if the country defaults?
Yeah, I mean, so I think you're absolutely right to say that financial markets do have relatively short memories. I mean, places like Argentina defaulting in 2001, within, say, 2 decades, issuing very long dated debt, in some cases to the same institutions, shows that actually financial markets are willing to give countries a second chance. Actually, I think this was one of the most interesting aspects of the Russian case, is that in the years leading up to the revolution, Sergei Witte, as the finance minister, I thought was an excellent strategist from the borrower's perspective. In other words, he was good at playing one bank against the other, one country, one creditor country off against the other. And I think he really appreciated the degree to which this is not just a story of amorphous financial markets and a single borrower. It's a story of humans. And so he invested a lot of time into building relationships with both finance ministries as well as individual bankers and stewards of financial markets to great effect. And ironically, the Bolsheviks, after the revolution, tried to seize on that same thing and play off the French, say, against the British, against the Americans, by maybe expropriating one country's industrialist factories and then offering them off at fire sale terms to another country. And so that, I think, is really a fascinating aspect of the Bolshevik thing, which, different countries today operate differently. Some of them may arguably be shrewder than others. But, another aspect is how much has a country borrowed from another country, and how much, in a sense, at a certain point, the creditor can become as dependent on the debtor as vice versa. In other words, if you look at China and the US today, to a certain degree, China can say to the US, well, we have a lot of your debt. But on the other hand, if the US is not doing well, that becomes a problem for a lot of countries that have parked a lot of their reserves in US government bonds. So who controls who in that situation is an interesting dynamic.
Very interesting. Also, when the examples you gave of the strategists and the people on ground, the financiers, who even at that time were writing notes which were disconnected with what was happening on ground. Do you think this was just a mistake in their reading of the situation, or do you think it was politically motivated? And then how did they get it so wrong?
Well, I think, Ali, both you and I have had our share of difficult calls in the past.
Sure. Yes.
So, when I was reading some of these guys' things, on the one hand, you have this feeling that, well, how can you be so stupid? Because we know how the movie ends for them. On the other hand, I was very sympathetic to them because they were trying to make their best decisions in a highly uncertain environment. And what struck me is that the framework of analysis changed for these individuals over the course of this story. So, in the pre-revolutionary times, 20, 30 years before the communist takeover, a lot of these guys were doing hard-nosed financial analyses. They didn't have Excel, but they were doing the equivalent of very detailed spreadsheet work, what have you. 1914 is an interesting moment in global finance because, in a sense, all the rules are suspended. It's actually not unlike COVID today, right? I mean, you had countries in the UK, for example, we had a Conservative Party that was the torchbearer of austerity for years. And that's all gone out the window today, in today's world. And in a sense, the war does that. And these investors' thinking also kind of goes through a phase shift. And so these guys that previously were all about the numbers and hard-nosed financial analysis, to your point, start to become more focused on politics, on the long term, on the moral characteristics of the Russian people. So it all becomes very fuzzy. And I think that wartime dynamic starts to pollute their analysis.
That's very interesting. Now, in the case of China, which has been in recent time a big creditor to emerging markets countries, including Pakistan, there's this fear that in the case if you default on Chinese loan, the outcome will not just be financial; they will come and take over assets. Like that's the inherent fear, not just asset. If you stretch that same argument, the fear is they'll come and violate maybe even the sovereignty of a country. Have you seen that in history happen before? And do you think that because did that threat exist in the case of Russia? And did people say that France will come and invade and take over?
Yeah, I mean, this is one of the fascinating questions that investors at the time were grappling with, because there was a lot of precedent for exactly that scenario that you sketched out of a creditor country coming in and seizing control of the debtor country's economy. So famously, this was called gunboat diplomacy. It happened all over Latin America. It happened in Egypt and the Ottoman Empire, where literally Western creditors came in with the support of military force and basically took over the public finances of large countries. Now, the interesting thing about Russia, and this is one of the factors that actually gave some of these Western investors comfort about Russia, was that Russia, as today, was always in a very different category, right? In the sense that it's not today even considered a developed market economy. It straddles both Europe and Asia. There's aspects of it that are highly developed. You know, they have an excellent university system, very highly literate population, but there's aspects of it that are very classic emerging market. And I think investors were really struggling to place Russia, especially Russia pre-revolution, which again was part of the European great power concert. They had defeated Napoleon. They were key geopolitical players on the European scene. So to think, and there was a quote in my book about this. One of the finance ministers, I believe, if I remember correctly, basically scolded the bankers, saying that, listen, we are not Iran or Turkey or Egypt. We're Russia. We're a European great power. We're a very developed market. And of course, you know, I think investors to some degree took a bit too much of that into consideration.
Very interesting. In the case of Pakistan, you know, debt is such a big issue and increasingly becoming a bigger issue. Are there any other insights which you think are relevant for Pakistan? And I thought one was interesting, the answer which you gave, that you said that the finance minister was very good in terms of developing relationships with countries and with donors. So perhaps that's one insight for Pakistan. But are there other insights which you can share?
Sure. So I think, you know, at a high level, yes, in a sense, the salesmanship aspect of being running an emerging market economy is very important. Having a good rapport with the brokerage community domestically, internationally, these things seem to, even though they seem very very minor in a sense, they seem to carry weight, at least in history. Another aspect, I think, is this issue of development strategy and debt strategy, and getting buy-in from the population at large and from different political constituencies for the economic trajectory a country is taking. Belt and Road is something that previous governments have embraced, and certainly current governments have continued to embrace. But it's sometimes been a question as to how broad-based that support may be in different sectors of the society. And so that, I think, is a very important aspect. And the third thing I would say is that, Russia, when you think about that vodka ban and the ruinous effect that had on the taxation, on the fiscal situation, I think that reflected a sort of imbibing from certain sectors of the Russian elite of global ideas uncritically. And I think at a moment when orthodox economics is really being questioned and challenged by the current COVID situation, but also the hangover of the 2008 crisis, sometimes a bit more of a critical engagement with economic ideas that are popular globally can be intelligent, because just because something is popular in Western universities doesn't necessarily make it relevant or correct for an emerging economy.
That's very, 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 very wise. So we're now open for questions. We have 20 minutes. As like always, the format for asking questions is that please write it on chat, and then I'll read it to Hassan. And in the meanwhile, I think that your point about salesmanship of a finance minister is really relevant, and I feel that that's something which Pakistan needs to improve upon, and then not just at the country level, but also at the company level. And we don't. I think investor relation is something which is underestimated, the significance of, and underinvested. You hardly see companies who have a dedicated IR person. And similarly at the government level, because of course the finance minister and the ministry is busy on so much other stuff, that I feel that they don't put too much attention on it, except for dealing with the multilateral donors, the IMF. Can you, maybe I can kick off with the first question. What do you see the role of private lenders, the asset managers, the debt funds? How relevant and big is this pool of capital for sovereign debt?
In the historic case, it was very significant. Interestingly enough, if you look at it today, a lot of sovereign debt is managed by large institutions. Back in the historical case, it was really individual investors buying individual securities. So Keynes has this famous article about the British Empire, that a man could sit in his armchair on a Saturday afternoon in London and buy securities from Egypt and India and Argentina. And what happened in Russia's case was actually the Russian government in connivance really with the French government engaged a lot of French retail bondholders, and the banks that banked these bondholders were in cahoots with the governments in a sense, and didn't really give the full picture to these bondholders, which came to hurt them. Today, obviously, the market is much more concentrated in the hand of large institutions. So it's a bit different, I guess.
That's very interesting. Because I think in the case of Pakistan, while we deal a lot with multilateral agencies, IMF, World Bank, Asian Development Bank, but I think that there's lesser knowledge of and interaction with the debt funds, both completely as an asset class. From a historical perspective, going back to that, your book on Russia, how did the relationship between France and Russia change post this? And what was the thought in France post the default?
Yeah. So France and Russia were kind of in this three-way relationship with Germany. So in 1871, France had a devastating loss against what would ultimately become Germany. And they'd always had this rivalry. And Germany was seeing what was happening in Russia and the rapid growth that was happening. And they were very scared of that, and arguably basically started World War I to preempt Russia from becoming too powerful. Now, ironically, France, of course, is an anti-monarchist republic. They were against the absolutism of pre-revolutionary France, and Russia is the most, despotic monarchy on the planet. And so they make these kind of very funny, strange bedfellows. And basically what happens is when the revolution happens, because about, 2/3 plus of French foreign investment was tied up in Russia, this becomes a huge problem for the French government, doubly so because they have essentially been marketing this debt to individual voters, not just to big institutions. So they're really sweating bullets. And Russia basically starts to play on this exact point with the French government, saying, we'll give you some money if you recognize this, if you support us on this or that. But then they also start, and I think this is where they probably overstepped the mark, they go over the heads of the French government directly to the French people who have lost a lot of money in these Russian bonds and try and speak directly to those governments. So basically between, say, 1917 and the early 1920s, you have a very, very tense relationship. But ultimately, in the 20s and certainly in the 30s, you start to see a normalization. And that goes back to your earlier point, which is that, both governments and financial markets have remarkably short histories and are remarkably willing to forgive and forget even massive debt defaults.
And why is that? Why do they have short memories? Because in the case of individuals or even companies, we know that if you have defaulted, it's difficult to go get a loan again. And why is that not the case for sovereign states?
Well, sort of business has a way of forcing practicalities, right? If you think about, I've been reading again some of these books on France after World War I, and we often forget just how bad World War I was for northern France in particular. I mean, Germany had flooded a lot of the mines when they were leaving the occupied territories. And France, because the US wasn't giving it any relief, it and Britain relief on debts, France was really desperate to generate any sort of, foreign exchange, any sort of trade. And so in this context of the immediate slump after World War I, that 1920, 1921 depression, which was particularly bad, a lot of governments are looking to restart the wheels of trade. And a Russian economy that's desperately in need of finished industrial goods and desperately in need of reconstruction becomes an attractive market. And so even though there's that memory of default, and that default happened at the expense of certain people in France, other constituencies are of course incentivized to do business with the Russians.
This is, I wonder whether this leads to a moral hazard issue broadly. This point, but Hassan, moving on, you also you invest in emerging markets. You look at emerging markets. For the audience over here, and also you're being watched on DBTV live. So thank you for the guys at DBTV for broadcasting this. My question is that when you look at emerging markets in general, or a country like Pakistan in particular, what are the key characteristics you look at in a company which makes it investable for you? And I don't want, I'm conscious of the fact that you're speaking on your personal behalf. So I just want a generic example in terms of if people listening, what can they do to make their companies more investable for an overseas investor such as yourself?
Yeah, I think there's many aspects. There is the usual thing that you want to see in a business anywhere, I guess, and strong competitive positioning, a resilient business model to new entrants, good positioning relative to suppliers and consumers. The sort of the Porter's 5 framework, but I think above and beyond that's the base case, I think, for a business anywhere. But I think above and beyond that, when we invest in emerging markets, we're conscious of the fact that these are by definition places where macroeconomic stability is not a given, where exchange rate crises come and go, often from totally unexpected directions. I think having a very strong sensitivity to the political backdrop, the political economy of a country is very important. So it could be in certain countries, you just don't want to be partners. You don't want to be invested in someone who is on the wrong side of the government. You don't want to be invested necessarily in industries that are likely to suffer from political backlash. And then we're also conscious of, or at least personally, I'm very conscious of, when you invest in emerging markets, there's a lot of transaction costs, right? There's the costs of trading in and out. Liquidity may be there today, it may not be there 6 months from now or 6 years from now. And so it really has to be a long-term approach, I think. And understanding that certain businesses can survive these ups and downs and these shocks. It's kind of having a more insulated business overall.
Well, thank you for that, and thank you for bringing the point of liquidity, because I think again it's one of those things which is underappreciated, and it's something which can be controlled. What we see in Pakistan is that companies have very limited free float, and their stocks are tightly held. And perhaps if the point, I think it is important for them to understand that if their stock becomes more liquid, then it becomes more investable for global investors. And as you said, that is a threshold. The cost of trading is the threshold which you look at.
Yeah, absolutely. I mean, I think, and it's kind of a chicken and egg scenario, which obviously you make reference to Pakistan. I've seen it in all the emerging markets to some degree or the other, where oftentimes it's a founder or a family that doesn't want to lose control in a sense. But there is that aspect of, and you see this increasingly in some emerging markets, it should be said, which is encouraging, that some controlling shareholders realize that actually, paradoxically perhaps, by giving up more control, the value of what they retain goes up, and everyone's ship is lifted. So absolutely. And the other point I'd kind of just interject on liquidity is, this is one thing Russia didn't do very well under Vite, was diversification of the funding base. Being dependent on just Britain and France was arguably a mistake the Russians made. They didn't invest enough in their relationship with US financial markets. And that became a problem for them in the early 20th century. Whereas I think actually that may be something that some emerging markets that are looking more to China, looking more to Europe, they're in a world which is more protectionist, more regional. That may be a beneficial strategy for a country level.
Thank you for that, Hassan. A few interesting questions. So the first is from Shahid Tarar, and he's saying that do you think that a default improves the fundamentals of a country, and that's why a decade down the road, investors are more forgiving because actually the past default has given the country better economic fundamentals?
Yeah, I mean, this is the sort of question that both financial market participants and finance ministers and the general public are always grappling with, because there is a certain point at which it just makes sense to reboot the computer, as it were, right? And I think it's very situational. And the difficulty in particular, I was speaking once to a former finance minister who will be nameless. He said that, look, even the mechanics of thinking about that as an institution are so difficult. I.e., if I'm the finance minister and I write to, or I tell my advisor, go do a study, go do an analysis on what would happen if we were to default. Just the risk of that leaking out into the financial market can become ruinous. Mm-hmm. So, in theory, at some point, for some situations, it may make sense. In practice, it's very, very difficult.
Mm-hmm. That's very interesting, and we are certainly not advising that. So that's for the disclaimer. A question from Farooq Khan: Russia's debt default and low stock market multiples. Do you think that they are linked? And how long the perception linger? And so how long the default impact lingers on the financial market?
Yeah. So, I mean, the big Russian default in external debt was 1918. Then obviously in 1998, they had another sort of debt/currency crisis. I think in Russia's case today, there is some sort of memory of that, but I think there's other aspects of Russia that are perceptions, and I don't say I agree or disagree on this, but they're out there. Perceptions about rule of law, perceptions about corruption. I do think Russia has made a lot of strides in recent years, but certain countries have achieved very strong brands, certain countries less so, and these are reflected sometimes in valuations. And ironically, a lot of the things that are spoken about today in terms of Russia, in terms of rule of law, democracy or lack thereof, corruption, are things that investors 100 years ago were talking about, but they were ascribing it less to the Soviet regime and more to the Tsarist regime. So the rationale really echoes.
That's very interesting. And going back to your earlier point about liquidity enhancing shareholder value, I just wanted to bring that point up. That Germany is a great example. In my career, I've looked at Mittelstand companies in Germany, and we saw a range of them going from that 100 to 200 million market cap to $1 billion over a period of 4 to 5 years because of the patriarchs selling down and creating more liquidity. Going to another question, it's from Irfan Sheikh, and he's asking that right now a lot of countries, there's a talk about debt relief for emerging markets. How do you see that playing out? The theme of debt relief for emerging markets.
Yeah, look, I think it's something that is an important theme. I mean, this is truly an unprecedented, at least in our lifetime, event that we've seen with COVID and the related trade disruptions and stuff. And there is a long literature on the context in which debt default happens. So Michael Thompson, the leading scholars in the field, basically talks about there's the fair weather borrower who will repay when times are good and not pay when times are bad. There's the stalwart who will repay when times are good and will fight tooth and nail to continue to pay when times are bad. And actually, Russia had that reputation during the height of the Crimean War when it was fighting the British Empire. It continued to pay its debts in gold, and that's one of the reasons investors said that it will continue to in the future. But then there's the lemon, which will not pay in bad times, and it will sometimes default in good times. So I think the context matters, and I think the fact that we're in such a severe health crisis globally, I think will lower the bar for a lot of creditors in terms of allowing some sort of relief. We're seeing it right now in national banking systems, but I think it's not too much to extrapolate that higher up to multilaterals or bilateral EM-DM relationships.
Thank you for that, Hassan. This was an extremely insightful session. Thank you for taking your time. And not only did we learn a lot, but I think it's inspiring for people in Pakistan to connect with people like you who have so much knowledge, experience, and have a depth of knowledge about these topics which are very relevant for Pakistan. So I think it's very inspirational for the people and for me as well to connect and hear from you. Thank you for your time, and have a good day.
Thank you, Ali. I'm very grateful. Thanks for the time. Thanks for having me.
Pleasure. Thank you for that.